Alphabet just reported earning per share of $9.11. Wall Street expected $2.89, and on paper that's a 215% earnings beat. But the stock fell after the earnings. The market was not irrational, the headline was. More than two-thirds of that profit never generated a single dollar of cash. Stripe out one-time investment gain, and Alphabet earned $2.85, and Wall Street expected $2.89. And Bank of America says that stripe out gain have come from the Anthropic revaluation. Google didn't beat the earnings, it missed. That's the first number. The other two are buried inside the cash flow statement. One of them has never appeared in Alphabet's history as a public company. Let's evaluate the actual consensus expectations heading into the quarter. While consolidated revenue exceeded consensus estimates, a segment level attribution analysis reveals a highly concentrated upside surprise. Approximately 83% of total revenue outperformance was driven by a single business unit, that's Google Cloud. In contrast, Google Search, which accounts for over half of total consolidated revenue, missed the buy side expectations. This indicates that top line bit quality was narrow rather than the broad based. Furthermore, operational efficiency metrics deteriorated as operating expenses expanded at a faster rate than the top line revenue, driven by a technical infrastructure development and specialized AI talent compensation. R&D expenditure increased 32% YoY, significantly outpacing consolidated revenue growth of 24%. This operating leverage reversal marks a notable shift from historical trends. This raises a fundamental question for valuation models. Can accelerated margin expansion in Google Cloud offset the structural cost inflation across the broader enterprise? Cloud business grew 82%, operating income tripled, margin went from 20% to 35%. 6 quarters ago, this business grew 28%. Let me be fair to the bulls, this is extraordinary. Backlog reached $514 billion, and existing customers are exceeding their contracted commitments by more than the half. That second number matters more than the first. Backlog is a promise, consumption is a payment. But something changed this quarter that alters how you read the 82%. This is the first quarter Alphabet booked revenue from selling TPU hardware into customer data centers, physical chips, sitting inside the cloud segment and inside that backlog. The CFO said cloud growth accelerated even excluding the hardware. The CFO didn't say by how much. So let's go to the balance sheet instead. Inventory up fourfold in 6 months. That's hardware being built for delivery. Here is why the distinction matters. Software revenue recurs, hardware revenue doesn't. They don't deserve the same multiple, but Alphabet reports that as one number, and Alphabet won't give us the split. So investors are being asked to value something they can't separate, and management guided that most of this revenue lands in 2027. So it gets bigger, not smaller. Now one more thing about that hardware, and this is the part I haven't seen anyone discussing. Go back to the paper gain from the opening. The stake that produced most of the Alphabet record profit is in Anthropic. Anthropic is also one of the Google Cloud's largest compute customer, publicly committed to million TPUs with multi-gigawatt capacity running into 2027 and beyond. And Google has committed up to $40 billion of investing into it. So the same counterparty shows up twice, once as a profit on the income statement and again as revenue and backing in the cloud segment. And look at the cash flow statement. Alphabet put $21 billion of cash into non-marketable securities this quarter. A year ago, that line was 1.4 billion. Real cash going out, paper gains coming in. Now I am not calling this improper, it's disclosed and it's legal, and vendor financing is completely normal in infrastructure cycles. But Alphabet doesn't disclose this overlap. And until it does, you cannot size how much of cloud's growth is arm length demand and how much is running on capital Google itself supplied. That's the revenue line. The margin line has the same problem, and it's the number everyone is celebrating tonight. If this is helping you read earnings differently from the headlines, consider subscribing Bhagat Capital. Here I do deep dive for the company's earnings and fundamental analysis. 35% cloud margin. Let me show you what's underneath it. Alphabet reports a line called Alphabet level activities. It lost 5.8 billion this quarter, up 70% YOY. What's in it? In the company's onwards, shared AI research and development, including the development of our general AI models. That is the cost of training Gemini, and it sits outside the cloud segment. So, cloud sells the Gemini powered products, books the revenue, report a 35% margin, while the cost of building the model that makes those products worth buying is charged somewhere else entirely. Allocate just half of that loss to cloud, the margin drops from 35 to roughly 24%. I am not claiming that allocation is incorrect. This is a legitimate reporting convention. What I am saying is this: when you compare Google Cloud to AWS or Azure, you are not comparing the same thing. And the peak is already in. Management guided Q3 margin down on expensive rented capacity and the Wiz integration. This margin of 35% is the ceiling and not the floor. Now the number I think actually moved the stock. Alphabet generated 39 billion of operating cash flow this quarter. It spent 45 billion on Capex. Free cash flow negative 5.9 billion dollars. Stay with that for a moment. For almost 2 decades, this has been one of the most reliable cash generating machine in corporate history. This is the first quarter in Alphabet's public life where it consumed more cash than it produced. And TTM free cash flow is down 20% while revenue over the same window grew more than 20. Cash generation is now moving in the opposite direction to the income statement. Then came the guidance. Full year capex raised by $15 billion in a single quarter, well above where the street was modeling it. And the CFO added that 2027 capex will increase significantly again. Here is what that does to the model. Capex was 23% of revenue last year. This year it's heading for 41. Even assuming operating cash flow grows a healthy 25 to 30%, full year free cash flow lands somewhere between break-even and 25 billion against the 73 billion last year. On a $4 trillion market cap company, that's a free cash flow yield well under 1%, and that's a lag almost nobody models. Depreciation was up 40% this quarter. Property and equipment on the balance sheet grew by 74 billion in 6 months. And note the mix: 60% of this quarter's spend went into server and not building. Servers depreciate over a handful of years, building over decades. So this charge arrives fast. The capex of 2026 becomes the EPS headwind for 2028. Now put three facts side by side. Free cash flow is negative today. Capex is guided higher this year and higher again for the 2027. A company cannot fund a rising bill out of cash flow that has already gone negative. So the money has to come from somewhere else. Turn to the financing section of the cash flow statement and you find exactly where. Here is the line to remember from the entire filing. Repurchase of stock, quarter ended June, 0. A year ago, that line was $13 billion. For a decade, Alphabet was a self-funding compounder, enormous cash generation, shrinking share count, fortress balance sheet. And now, diluted shares are rising. There is a new preferred dividend ranking ahead of the common equity shareholders. Alphabet did not buy back a single share this quarter. It did the opposite. In June, it raised nearly $50 billion of equity, issued another $25 billion of debt, and authorized a $40 billion program on top. Long-term debt doubles in 6 months, and the CFO said on the call that a year ago the portfolio was around 16 billion. It's now around 100, and interest expense went up fivefold in 12 months. This is no longer a company returning capital, it's a company raising capital. Management pushed back on this framing, and you should hear it. The CFO said Alphabet does not plan to return to the equity market apart from the ATM program, which covers taxes on stock compensation. Funding order is cash flow first, then the debt. Take that at face value if you like. I would note two things. That program is up to $40 billion of stock, and the preferred convert to equity by contract. Neither is a plan to issue. None of this is automatically bad. If returns clear the cost of capital, this leverage is correct. But this is a structurally different security than one of the most people think they own. and it deserves a different risk premium. Let me argue the other side. I would rather be accurate than bearish. The bull case is that Alphabet is supply constraint and not demand constraint. The CFO said it plainly. Demand outpaces the capacity. They are renting expensive third party compute at poor short term economics because the multi year contract behind it is worth it. You don't do that for a customer who is not real. And then there is a search business, the part of this business that gets undercovered. 17% growth at 63 billion of scale for a business everyone buried 3 years ago. Management gave two data points aimed straight at the cannibalization bear case. First, AI overviews and AI mode are expansionary. Total query volume is going up, and Google says it's spending billions of clicks to the open web every week. Second, the cost per AI mode response hits its lowest level since launch. On valuation, you are paying about 24 times forward earnings for 24% revenue growth. If the Capex converts, this is cheap. Three things make the September quarter mechanically harder. None of them have anything to do with AI. YouTube growth was flattered by the World Cup. 1.7 billion viewers, that does not repeat. Search begins lapping the acceleration that started in Q3 last year, and the CFO guided an FX headwind after a tailwind this quarter. If Q3 decelerates, check those three before you conclude anything about AI or competition. One more thing on the backlog. Cloud backlog nearly doubled last quarter. This quarter, it added a fraction of that. Bookings are lumpy. Q1 clearly had a mega contract in it. One data point is not a trend, but the backlog is exploding. A story is holding up a lot of this multiple, so that number matters next quarter. So, three things that would change my view. I will check all three in October, and if they break against me, I will say so here. 1. The TPU hardware split. Above 60% X hardware growth, the bull case holds. If in the 40s, then that 82% was partly an accounting artifact. 2. Q3 free cash flow. On this guidance, it should be negative again. If it's positive, operating leverage is beating Capex, and I am wrong on the cash thesis. 3. Backlog additions. Above 100 billion, demand is accelerating. Below 50, Q1 was one off. And here is where I land. Alphabet is executing better operationally than at any point in the last decade. That is not in dispute, but it has stopped being a cash generating machine and started being an infrastructure builder financed by the capital market. The market priced that tonight correctly. This stock is not expensive on earning, it's expensive on free cash flow. Those are not the same thing, and the gap between them is 200 billion a year of capex, whose return nobody can verify until 2028. That's not a reason to be short. It's a reason to size the position for what you are actually underwriting, a story, not a cash flow. And to know exactly which number would tell you the story broken, I will be tracking all the three here every quarter. Tell me in the comments which of these three conditions you think breaks first. This video is for educational and informational purposes only. It is not an investment advice, not a recommendation to buy or sell any security, and does not account for your personal circumstances or objective. I am not acting as your financial or investment advisor. Thank you.